Imagine waking up one day and seeing that a stock you own has dropped from rupees 1000 to rupees 200. Your heart skips a beat. Did I just lose 80% of my investment overnight? But here's the twist. You own more shares than before, yet your investment value remains exactly the same. This isn't some accounting error or market manipulation. It's a deliberate corporate action. Infosys, TCS, and even Reliance have done this multiple times throughout their journey. As an investor, should you celebrate, worry, or simply ignore it? Stock splits are a strategic corporate move with several purposes. From making shares more affordable for retail investors to potentially influencing future price movement, there's more to this story than meets the eye. And in this video, we'll learn 5 things. What is a stock split? Why do companies split their stocks? What changes and what doesn't? What will happen to your stock if it splits? And some things to remember. Let's begin. Think of it this way. You own a 1 kg gold bar. It's valuable, but not many people can afford to buy the whole bar. Now imagine melting it down and selling it in 10-gram pieces. Same amount of gold, same total value, but suddenly a lot of buyers are now interested. That's what a stock split does. It breaks down a high-priced share into smaller parts, making it more affordable for investors without changing the company's value or your investment. You've got the concept. Now let's see it in action. Here's what a 1:5 stock split looks like. As you can see, before the split, you held 10 shares, each priced at rupees 1000 for a total of rupees 10,000. After a 1:5 stock split, for every 1 share you held, you now have 5. You now hold 50 shares and the price per share has adjusted accordingly to rupees 200. Your total investment value remains the same, rupees 10,000. More pieces but same value. And just like that, the company has made the stock more buyable for more people. Now let's understand why companies split their stocks. Now, there are a few practical reasons for this, and they mostly come down to making the stock more accessible, easier to trade, and potentially more attractive to a wider set of investors. One common reason is accessibility. When a company's share price gets too high, it often becomes unaffordable for many retail investors. This can reduce overall participation in the stock. And to fix that, companies sometimes do a stock split, where they reduce the price per share without changing the actual value of the company. The idea is to make the stock more accessible and improve liquidity. To understand this better, think of a 2000 rupee note. It holds full value, but it's not always convenient for smaller transactions. If you break it into 10 200 rupee notes, the value remains the same, but it becomes so much easier to use. A stock split works in a similar way. Same overall value, but lower cost per share makes it more accessible and easier to trade. For example, in 2023, Nestle India announced a 1:10 stock split, reducing its share price from around rupees 20,000 to rupees 2,000. This made the stock more affordable for a larger group of investors, especially those who were previously priced out. Another reason is to signal confidence. A stock split can sometimes indicate that the company is optimistic about its performance and wants to encourage more participation. While it's not a guarantee of future growth, it's often seen as a positive signal to the market. There's also the role of investor perception. A share priced at rupees 1,500 may seem more approachable than one at rupees 15,000, even if both companies have identical fundamentals. It's like a psychological effect. Much like how something priced at rupees 999 feels cheaper than rupees 1000, even though the difference is minimal. On the flip side though, not all companies opt for a stock split. Take MRF for example. Even with its share price soaring above rupees 1.3 lakh, it hasn't gone for a split. And that's likely because a split wouldn't reduce the price enough to make a real difference. Plus, MRF might actually prefer having fewer, more serious long-term investors instead of encouraging more frequent trading. Similar to Warren Buffett's strategy with Berkshire Hathaway. To learn more, check out the link in the description. So overall, stock splits don't change the value of what investors hold, but they do help improve affordability, trading activity, and sometimes reflect how the company views its future. So while a stock split makes shares more affordable and improves participation, it's important to understand what's actually being affected. So what changes and what doesn't? So if you're holding 10 shares and the company announces a 1:2 stock split, you will now have 20 shares. So in a stock split, the face value of a share, which is its nominal value on paper, is reduced in proportion to the split. For example, if the face value was rupees 10 before a 1:2 split, it becomes rupees 5 after. This doesn't affect your investment or the company's valuation. This is mainly for accounting and regulatory purposes. In a 1:2 split, the price per share reduces by 50%. And now let's look at what doesn't change. If your investment was worth rupees 1 lakh before the split, it remains rupees 1 lakh after as well. The number of shares and price per share change, but not the overall value. Metrics like earnings, revenue, and business model remain unchanged. While the earnings per share adjust, the PE ratio remains the same because both price and earnings per share adjust proportionally. Since the share price drops, but the number of shares increases, the market capitalization or total value of the company remains unchanged. A stock split is not a taxable event. You don't have to pay any tax when your shares are split. Capital gains tax only applies when you sell. Now let's talk about what you'll notice in your account when a split occurs. Before getting into understanding what will happen to your stocks, you need to understand these 3 dates in case your stock is chosen for a split. The key dates that you will have to remember will be: number 1, record date. This is the date when the company checks its books to identify eligible shareholders for the stock split. To be eligible, you must be holding the shares in your demat account as on the record date. Always remember, because of the T+1 settlement cycle, you need to buy the shares at least 1 trading day before the record date to qualify. Number 2, ex-split date. From this day forward, the stock will start trading at the new reduced price. Number 3, credit date. This is when the new shares get credited to your demat account. It can take 1 to 2 business days after the record date. So if you don't immediately see the updated share count, don't worry. That's standard settlement timing. So now, what will you actually notice around these dates? Let's walk through it. You may see a temporary drop in your portfolio value, but it's not a real loss. On the ex-split date, you might log into your trading app and see that the stock's price has dropped sharply, sometimes by 50% or more. This can look alarming at first glance, but it's completely normal. Think of it like your bank app showing a check deduction before the actual money arrives. The split reflects instantly, but the new shares take a day or 2 to catch up. So yes, you may see a dip in your profits for a short while, but it's not a real loss. It's just the system catching up. If you ever want to check stock splits or other corporate actions for a stock, you can view them right on Kite. If the stock is added to your market watch, you will see an event tag. Tap on the stock, scroll down and tap on fundamentals and then on events. If you don't have a Zerodha account, you can open a trading and demat account entirely online, provided your phone number is linked to Aadhaar. Check the link in the description and follow the on-screen instructions. To sum it all up, let's go over the most important takeaways. Number 1, you don't need to do anything. The stock split happens automatically. If you're holding the stock as on the record date, the new shares will be credited to your demat account. No action required from your side. Number 2, you're not getting extra value. A stock split doesn't increase the total value of your investment. It just gives you more shares at a lower price. Think of it like getting 500 rupee notes instead of one 500 rupee note. Number 3, don't buy just because of the split. Just because a stock is splitting doesn't mean it will rally. Splits can boost participation, but the company's fundamentals remain the same. Don't buy a stock just because it's appearing cheaper. Evaluate it like any other investment. Number 4, face value changes, not fundamentals. In a stock split, the face value of the share reduces, but the company's fundamentals and financials remain unchanged. Number 5, you can sell only credited shares. If you had 100 shares before the split and the split is 1:2, your demat may still show only 100 shares for a day or 2. You can sell those 100, but you will need to wait for the additional 100 to be credited before you can sell those. Keep these reminders in mind the next time a stock split comes your way. And if you have any queries about stock splits, please feel free to leave a comment below. We'll be happy to answer them.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing. Brokerage will not exceed SEBI prescribed limits.